Hi everyone, Tim Harridge here again. I just want to say thanks for coming inside the website to look at this video training. Little ground rules here. As we go on, down below there are questions. If you have questions, please ask them below. What will happen is I will personally log in and answer the questions. So we're here to talk about exit strategies, and really with exit strategies, I like to break everything down into three areas. You have wholesale, retail, and long-term buy and hold. So what we want to do in the next part of this training is really cover each area independently. So we'll start with wholesale. Okay, so wholesaling, as we talk about exit strategies here today, I want you to be cognizant of supply and demand. So wholesaling really only works if you have the supply of end buyers. So one of the things I've always done, even as a wholesale investor, is when I started out in this business, I went to a lot of real estate investor clubs, networking parties, just to build a buyer's list, to network and talk to people. But what you do different as a wholesale investor that will really make you successful is get to know your demand. Because you don't want to go find a bunch of, in Dallas, 3-bedroom, 2-bath, 2-car garage brick houses if the only investors you know are looking for 3-bedroom, 1-bath frame houses. It makes no sense. So we're going to use just a common example. So say it's a $100,000 house. I like saying a $100,000 house because it's easier math for me. And it's a 3-bedroom, 2-bath, 2-car garage, brick home. So the way wholesaling works the best, and the easiest way to describe it, is if I go out to a networking event and I meet Brian, and Brian tells me he wants to buy a 3-bedroom, 2-bath, 2-car garage brick home in Garland, Texas, I'm going to talk to Brian about, Brian, what are you going to do with the house? Are you going to fix and flip it? Are you going to buy and hold? Are you a landlord? Are you going to own or finance it? Or are you going to try to wholesale it to someone else? Because that happens a lot. So Brian will tell me his criteria. So Brian may be looking for $20,000 in equity and repairs no more than $15,000 in repairs. So what will happen is, once I go look at the home and I determine it's worth $100,000, what I want to do is back out the repairs. So what we're going to do first is back out. Brian wanted his $20,000 equity, right? So now that puts us to $80,000. That's what Brian is willing to pay for the home before repairs. But Brian didn't want anything that needed repairs more than $15,000. So when I looked at this, say this house needed $20,000 in repairs. Well, I'm not going to call Brian and waste his time on this because he clearly already told me he's not interested in this. And this is where having a bigger buyer's list will make you more successful in networking up front, going to real estate investor clubs and all the meetings you can will give you a bigger list and broaden the amount of which properties you can pursue and which ones you can't. So, see, this example would actually make it where Brian's not interested in this house. But for illustration purposes, let's say that I walk the house and I feel like it only needs $14,000 in repairs. So when you subtract this, it tells me that Brian would pay $66,000 for this house. So this is where supply and demand 101 comes in. If I am very confident in this number and very confident in this number, if I've been trained properly, then all I have to do down here is back out how much money I want to make. It's that simple. So if I'm only looking to make $1,000 because I'm new and this is my first deal, then I just back out $1,000 and I offer the homeowner $65,000. And that is really the way I operate my business. Is depending on if I'm going to wholesale a house, depending on who I'm thinking about wholesaling it to or where the broadest market is, I figure out a base number that I'm pretty sure I can sell it for, and then I just back out the difference. So on deals where you're competing with more people, this number has to be lower. On deals where you may only be the only buyer involved, you can try to push this number a little higher. just being careful never to get greedy, because what will happen is you'll price yourself out of competition. So that's wholesaling. Now let's talk about retail. Okay, so now we've talked about wholesale investing. So let's talk about fix and flip, because fix and flip is it's that part of the business that has really made buying ugly houses an attractive thing, but it's actually the area where most people lose their money when they're uneducated and not well versed in the terminology. And I'll show you why. The big TV shows, they love to show you this $100,000 house that, just like in the last example, that you can go buy for $65,000 that only needs $15,000 in work. And here's the way they do it. They show you $15,000 in work that we paid $65,000 for. And then the last graphic on the last screen of the show says $20,000 profit, right? And this is one of those things that my wife and I at home always joke about on these big TV shows is they're creating an uneducated public. And here's why. I take Texas, for instance. In Texas, you're going to pay a commission. You're going to pay a real estate commission. Even if your husband or wife is licensed, you can try the for sale by owner route, but 90% of sales or more come through the MLS and through a realtor. So at a minimum, you're going to pay a 3% commission on this $100,000 house. So there's $3,000. Now, some people are sitting there watching this video thinking, no, I'm going to sell it on my own. And you may get lucky. But the thing about getting lucky is you don't count on that. You don't plan your business on getting lucky. It's just not good business practice. So you got at least $3,000 in real estate commission. So already, this is not $20,000. This is $17,000. Okay, so we're already down to that. Closing costs. When you sell this house for $100,000, are you going to pay any closing costs? If you're thinking no, then you're not really paying attention to the buyer's market that we're in here in 2012. So on average, you're going to pay at least 5% in closing costs. That's title policy, survey, escrow fees, seller contributions. So now we've lost another $5,000 of this. So now this 17 is already down to $12,000. So now we got, when we bought the house, did we have any closing costs? You know, it's one of those funny things, and we're going to talk about this in the next video, the financing video, but so many people don't really, new investors, they don't really keep track of their expenses, and what happens is, at the end of the day, yeah, they may get a $20,000 check at closing when they sell the house, but it's not profit. So you really got to look at what your purchase closing cost. Did you pay points on your loan? I'll tell you, I mean, even after 10 years of doing this, I still pay almost a point on every loan I borrow, unless I pay cash. So we're just going to assume for this example that you pay cash, that you have $80,000 in cash sitting in a bank account that you can tie up for 4 to 6 months. So you wire that $80,000 to the title company, or you only need $65,000 to close, and you're going to pay at least 2% in closing costs. Most likely it's going to be more, but by the time you count the escrow fee and the title policy and any surveys or anything like that, it's going to be at least 2%. So 2% of $65,000 is, what is that? That's $1,200 plus, that's $1,300. So So 2%, that's $1,300. So now we're down to 10.7. So we're to 10.7, and then let's talk about how long you've owned this home. Most likely you've owned the home for at least 3 months by the time you close on it, fix it, sell it, and close on the sales contract. Unlike the big TV shows, when you sell a house, it doesn't happen the day after the contract's written. There's a 30-day appraisal process, an inspection process, an option process. It's not as quick as it seems, where the day after you rehab it, you put a for sale by owner sign in the yard and say, look at me, I made $20,000, because there's such a thing as a loan closing. Not everybody walks around with cash to buy houses. In Texas, I can tell you that the property taxes alone for this $100,000 house are going to be about $3,000 a year. So if it's $3,000 a year, you're looking at about $250 a month in property taxes. So let's just say, for math's sake, that you only own the house for 4 months. So that's $1,000. There's another $1,000 in property taxes. Now, you don't have to pay that monthly, but when you sell the house, the county wants a check. So now we're down to $9,700. Now, again, we assume that you paid cash for this house, so there's no interest. So if you had interest, if you used a hard money loan or something like that, well, we can almost wipe this whole number out, but we'll just say that you paid cash. But what about mowing the yard? Most likely, in Texas specifically, you're going to have to mow the yard, trim the bushes, keep up with the house. And then you've got utilities. You've got a vacant house that is chewing up utilities. So we'll just say maintenance and utilities, we'll call it $300 a month. Now, for 4 months, that's $1,200. So already, now that $9,700 is $8,500. So we're not even done, and we've already reduced this by well over 50%. So the point is, with retail fix and flip and the exit strategy, you really need to understand your cost of funds, and we'll talk about that in the next video for financing. And you've got to have a realistic expectation for days on the market, because all of these numbers start to creep up. Now, this is not an accurate comparison, because I can tell you, just in my experience, I lose on average 11% at the closing table whenever I sell a house in commissions and contributions and closing costs. So this 5 and 3 for me would actually be $11,000. So I hope this helps. So now let's talk about buy and hold strategies and when that's right for someone. So the third exit strategy is buy and hold. And this is where wealth is created. It's where passive income comes into play in real estate investing. And ultimately, if you're watching this video, that should be your goal. Your goal should be to generate wealth and security for yourself, your family, and future generations of your family. So let's talk about some considerations for buy and hold and really how that works. So we're going to start off with that same $100,000 house. Again, not because every house in Texas is worth $100,000, but because it's easy math for me. And that's really what's important. So the same $100,000 house, it still needs $15,000 repair. And we're still going to try to buy it for $65,000, because that's kind of our break-even point, because what happens is if we're not able to get it worked out on the buy and hold side, we still know Brian, and we can wholesale it to Brian, try to make $1,000 and then move on. So that's how that works. But let's talk about the mechanics behind this. So again, we're going to assume that you're going to pay cash for this, because we'll talk about financing and interest rates and all that in a couple days in the second video. But let's just assume that you pay cash for this. So you pay cash. You pay cash for the repairs. You're in it for $80,000 plus closing costs. You're in it for about $82,000. Now, let's assume that this $100,000 house will rent for $1,000 a month. That's kind of the going formula here in the Texas area. So we'll just stick with that. And I know that specifically in the Northeast, these numbers change drastically, but that's where leverage becomes crucial. But let's just say it's $1,000 a month. So that's $12,000 a year. Now, what you can't do is make the assumption that that $12,000 is all profit. And here's why. Remember those property taxes I told you about? Well, this guy, you still have to pay. Now, the other thing you have is insurance, property insurance. So in this house, let's just say we're going to say $1,000 a year. It should be around $700 to $800, but you could be like some of the investors I know that actually use State Farm for their rental insurance, or one of the other big name companies, even though it's more expensive than a smaller company. Some people are willing to pay that extra couple $100 for security. So You don't have any principal or interest because you paid cash. So you got 3 and 1, so that's 4. So now your cash flow, your net cash flow is down to $8,000. So it's still not that bad. It's an annual cash flow of $8,000. You paid $82,000. It's a little less than 10%. If you're watching this video right now, you're thinking, wow, that sounds pretty good. Yeah, it does. I mean, especially since, what do you get nowadays in a CD? Like 0.5%? So you're at $80,000. And remember, I mean, guys, if you've got questions, just top them below. We'll go, I'll do my best to get them answered quickly before the financing video. So you've got this $8,000. The one thing that you're missing here is maintenance and vacancy factor. And this is where a lot of real estate investors or new real estate investors become old real estate investors, is because they don't account for maintenance and vacancy. And if you're going to buy and hold, I'm telling you, as sure as the day is long, people will move out of the home. I don't care if it's on owner finance. So the average owner finance tenant of mine stays 7 to 8 years. And then they decide to sell it or they move. It's funny. I mean, I have people that on owner finance stay in a house for 6 years and then just mail me the keys with the final payment and say, thanks, they bought a bigger house. It's just one of those things, guys. So maintenance and vacancy. So you're accounting for maintenance and you're accounting for vacancy by deducting from rent. I like to tell people that you need a 15% MMR, maintenance, management, and repairs. So if you're losing 15% of $12,000, that's going to be, what is that? That's $1,500 plus $300, that's $1,800. So now we're down to $6,200. Now, you're still, if you're operating just $6,200 off of an $82,000 cash investment, you're still doing okay. You should be, what is that? That's about an 8% return, 7%, somewhere in there. It's just below an 8. So, I mean, you're still doing okay. And I know for some of you, especially if you're just now thinking about real estate investing, you're thinking 7-8%, sign me up. But in real estate, we like to keep the returns a little bit higher because here, this 15%, that's $1,800 a year, and that's if you don't have a full-time property manager. A lot of you that have a full-time job are going to have a property manager, so that's another $1,200 you're going to lose here. So that puts you down to $5,000, and now you're down into the 6% range, which I mean, I don't know, that may be good for you, but we always target more. So anyway, that's really just kind of some considerations to buy and hold. I'll tell you, and we're going to talk about this in the next video, financing, that the best way to make this number work well is to take advantage of today's rental opportunities with low interest rates, because you can leverage this money and you may end up with only $10,000 to $20,000 out of pocket on a conventional loan, and then if you're bouncing even $3,000 off of $20,000, your returns on that cash is a lot higher than 10%. So that's just a brief overview of buy and hold considerations. And tell you what, let's go ahead and just move on to the next topic that we want to talk about today, and that's just supply and demand. So let's talk about supply and demand. So on supply and demand, it's just real crucial that you design your business based off of who your target consumer is. And we're going to talk about this in depth, specifically in the property management phase, where we're going to talk more about vacancy factors and area considerations and project management, and then also in the sales, because with sales, that's wholesale and retail, you just have to really think about who your target consumer is. When you're picking where you're going to advertise, what type of renovation you're going to do to a property, both on the rental or the retail side, because the type of renovation that you do is going to influence the tenant or the buyer. And you have to understand that as well as a wholesaler, because as a wholesaler, if I'm trying to wholesale this house to Brian and I say it needs $15,000 worth of work, but Brian is a retail fix and flip investor, he's probably going to spend $20,000 on it because he's going to put in nicer appliances, nicer countertops, nicer flooring. So it's just real important that you understand the demand for the houses you're looking at, because if you don't understand the demand for those houses, it's going to be real difficult for you to sell the property. And ultimately, at the end, we're going to talk about that in a couple videos from now, but understanding where your demand's coming from is the crucial part to determining which exit strategy is good for each individual house. So that wraps up this video. I appreciate you watching. Make sure you ask questions below. I'll be happy to answer them. And in a couple days, I'll send you an email with a video for financing, where we'll talk about hard money loans, bank loans, conventional financing, private money, how to use it, and private money, where to find it. So thanks for your time, and we'll see you in a couple days.